Hi everyone, it's Anand here. I know the big question on everyone's lips. Where is the stock market going next? This is amongst a heap of other questions, such as, has the V-shaped recovery already happened? Did I miss it? Will I get another chance? We know the market has rallied significantly since the lows it reached in late March. But with all the economic uncertainty around us, we still don't really understand why the markets keep going higher and higher and higher. If you're digesting any sort of financial information at the moment, you're hearing a lot of contradictory opinions. Some are saying the markets are going to get higher and higher, wiping out all the falls of the recent months and going to end the year in a higher position than where the stock market started in January. On the other hand, you're seeing people say the second market fall is coming. We're going to hit lower lows than what we got at the end of March. And we're at the brink of a massive depression. The other big question I keep on hearing about, and rightly so, is with all of the economic signs we see around us, even as we start opening up again, it's pointing to the fact that our economy is going to do badly, at least for the next few months, even for the next few years, as we deal with the outcome and the after effects of this crisis. So why then is the stock market behaving so differently? The market's just going higher and higher, almost wiping out all of its previous losses. What's the deal here? Well, this video isn't actually about answering that question. But what I've tried to do in this video is give you some insight into how previous crashes have gone. What has happened? How much have they crashed? What has happened in the immediate aftermath of those crashes, rallies, further falls or otherwise? And how long has it taken the market to fully recover all of those losses from the initial falls? I've done all the research and analysis on this topic, so you don't have to. If I've done my job right, what this video should do is give you the insight and information and a shortcut to making the decision on what you should do in the current market situation. Before I jump into the rest of the video, two quick things. Number one, if you've got any questions on how to manage your finances better, leave a question in the comment section below and I'll do my best to answer it right there. Or you never know, I may even make a video on those very topics. Number two, a lot of people mention these. They are slanted on purpose. It is not a mistake. Okay, so back to the main topic of the video. What is the stock market likely to do next based on previous stock market crashes? To answer this question, I've looked back at 4 separate stock market crashes of the recent past. I had intended to look at only very, very recent crashes. However, the crash of 1929 did lead to the Great Depression, and it felt very, very relevant to the kind of market conditions we're seeing right now, or at least what we saw at the start of the year. So I wanted to include the stock market crash of 1929 as the first example amongst 3 others. One thing you'll notice is I'm using US stock market indices to analyze this topic. Some of you in my neck of the woods in the UK may ask the question, why am I not using the FTSE 100, which is the UK's largest stock market index? Well, I'm not using the FTSE 100, I'm instead using the S&P 500 from the US. And this is because over time, at least over the last 20 to 25 years, between the S&P 500 and the FTSE 100, the S&P 500 has vastly outperformed the FTSE 100. Largely because it has a larger diverse number of stocks. As the name suggests, it looks at the top 500 equities in the US. And therefore, I believe it's a better indicator of economic strength and economic weakness. So 1929, after almost a decade of growth, that's why it was called the Roaring Twenties, overconfidence settled in. And from reaching a high of 381 points on the 3rd of September 1929, the Dow Jones Industrial Average began its nosedive. You may have noticed I just said the Dow Jones Industrial Average instead of the S&P 500 I mentioned a moment ago. There's a really good reason for that. The S&P 500, not Dow, the S&P 500 didn't exist yet. It was introduced by Standard & Poor's in 1959. But don't worry, the S&P 500 will be the basis of analysis for the next 3 crashes. So the Dow Jones, it started falling from a high of 381. Within 6 weeks, it reached 299. That's a worrying 21% fall. Then came the obvious rally. Within 5 months, it came within touching distance of 300 again. But before it got there, a second fall occurred. This fall took a much longer period of time, but by July 1932, the Dow Jones had fallen to an incredible 41 points. That's a staggering 89% fall from its high of 381 back in 1929. It didn't reach the highs of 381 again until November 1954, or 9,212 days later, to over 25 years. Now that's what a Great Depression can do. If you plot those figures on a graph, this is what it looks like. Next, we head to the famous stock market crash of 1987. The S&P 500 reaches a high of 337 on the 25th of August. By the 19th of October, however, it has fallen over 33% to hit a low of 227. After a brief rally, the market crashes again, and over the next 4 weeks, it reaches lower lows and bottoms out at 221 points. The S&P 500 doesn't make it back to its previous highs until 1989, or 701 days later. Again, those figures plotted on the chart, this is what it looks like. Noticing any patterns yet? Second to last, we're heading to 2002 now, before we head to the financial crash of 2008 and see how all that unfolded. So we're in 2002, having seen the first part of the dot-com bubble crash and having the world change forever after the 9/11 attacks. The S&P 500 hits 1173. By July of that year, the market is at 775. Okay, so it's not a 1 day or a 2 day drop, but I'm not going to quibble when the market has just dropped 34% in 6 months. It quickly rallies 24% over the next month or so, but then a second drop comes. This time, the market reaches an even lower low of 768. It takes 976 days, or over 2.5 years, for the S&P 500 to wipe those losses out and make it all the way back to 1173 again. Again, this is what the chart looks like. There's a pattern certainly emerging from all this, isn't there? Okay, it's time to talk about the financial crisis. It's 2008. We all remember this one, don't we? How could you not? The S&P 500 is soaring. By May 2008, a high of 1440 is reached. But then on the 10th of October 2008, the S&P 500 has crashed to a low of 839, a whopping 41% fall. There is a bit of a rally. We see the S&P 500 getting higher than 1,000 again, but then a second wave of selling comes along and the market crashes again, this time getting to 801. Over the next few months, there's a lot of sideways movement as we start wondering whether the market has got over the worst of the crisis, whether all the measures put in by governments across the world have worked. But no, we see another crash, a third one. This time the S&P 500 zooms way past 700, ends up at as low as 666 points. It takes over 4 years for the S&P 500 to recover all of those losses and get back to above 1440. In all of these examples, one thing you can be absolutely sure of, and this is across history, the markets do eventually recover, but the time to recovery varies dramatically, and there are several waves of recovery. The first crash is very rarely the only crash. There are rallies, then there are crashes again. Sometimes previous lows are reached, sometimes previous lows are exceeded, and the market goes even lower. Do we know whether any of this will happen this time around? No, we don't. And we know that past performance is not an indicator of how the market will unfold in the future, but it does give us some insight into what has happened before. We all know that markets are run by people. Okay, well, algorithms as well, but mostly people. And people are run by their emotions. Collectively, this is called sentiment. Looking at the markets this year, the S&P 500 made a high of 3385 on the 13th of February. The pandemic then hit. A global economic shutdown ensued. We all went crazy over toilet rolls and the market tanked, reaching a low of 2191 on the 23rd of March. Since then, there's been a massive rally in the S&P 500, reaching 3233 on the 8th of June. And this is what the chart currently looks like. What will happen next? Well, only the future me knows. But what I do know at the moment is that there's a lot of hurt out there in the markets at the moment. And as we begin to open back up, I feel there's a lot of hidden economic pain still to be experienced by the markets and still to be taken into account. But who knows, you may be watching this video in a couple of months and already know the answer. If so, leave me a comment in the section below and tell me I was right. I hope you enjoyed that video and got some value out of it. If you have, give it a thumbs up by turning that button blue, alternatively known as smashing that like button. And leave a comment in the section below and tell me which way you think the market is going to go next and why. But that's all from me for now. I'll see you in the next video.